Bond market bulls getting it their way this week. Live from New York City this morning. Good morning, good morning. Equities near session highs. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the payrolls data favoring the bulls. As Fed officials back away from doing more, Apple puts a downer on a big week of gains. We begin with the big issue, payrolls in America.
Look at the economic data.
The jobs report.
It's always important.
Incredibly important.
The labor market is the key right now.
Key indicator.
Key thing that investors across asset classes are going to be watching.
We are gradually seeing a slowdown in the pace of hiring.
Continued moderation in the labor backdrop, even if it's uneven, I think is going to persist.
It all comes down to the wage numbers.
We really haven't had wages that are slowing over the past few months.
The key thing for payrolls is really about how much support there is for the consumer.
So far, the U.S. consumer has been incredibly resilient.
We're seeing a lot of cracks in the consumer story starting to emerge.
Everybody's trying to figure out what the underlying trend in the labor market is.
How is the job market evolving over the coming months? And are you starting to see some of that job pain?
It all comes back to jobs.
Joining us now to discuss is Mohammed Al-Erin of Queen's College, Cambridge, BlackRock's Rick Reader. Gentlemen, let's get straight to it. Mohammed, your take on a payrolls data from 31 minutes ago.
So on a standalone, John, Goldilocks for markets and consistent with a soft landing for the economy. Job creation, yes, slightly less than expected, but nothing drastic, nothing suggesting a collapse in the labor market. Unemployment rate, yes, higher, but very little. And wage growth slightly down in terms of what we've seen month on month and year on year. So if you take all that, it reinforces what has been a very dramatic week. The only thing I did not like was labor force participation. That came down. And as Chair Powell said 2 days ago, and you saw the reaction of the market just loved it because high labor force participation is good for growth, for inflation, for stocks, for bonds. We need to continue to enhance the supply side. And unfortunately, labor force participation came down. But I think on the whole, this is going to be welcomed both by markets and the economy.
Well, you said the market loves it. Bond market loves it. We're down 12 basis points at the front end on a 2-year, 487. Rick, on a 10-year, we're down 12 to 454. It's only a few Mondays ago. We had a 5-handle on a 10-year. We're now back to about 450 on a 10-year. Rick, it's not amazing. It's not fantastic. It's not terrible either. It's not brutal. What is it?
So I'd say a couple of things. I agree with everything Mohammed said around the numbers. You know, the one thing, a couple of other points I would make relative to that. One is, you know, it's interesting, you know, we've talked about it in the show before. If you look at things like healthcare and education, another 89,000 jobs positive is only 150 total. You take that out and then take out leisure and hospitality, which have been strong. The cyclical components continue to moderate down. I think that's a really big deal. And then, you know, the other side of it is, you know, if you take all the economic data we've gotten, it's all indicative of an economy that's slowing moderately, very moderately, but slowing. But the labor data has been solid. I mean, look at the JOLTS report this week. Claims is still solid. The ECI is still solid. Now you're starting to see there is a lag dynamic. Now you're starting to see that for the Fed. It's a really big deal now that you're starting to see labor be symmetric to what you're seeing in other parts of the economy and the economic data.
Euro's down big time, dollar weaker, euro stronger, 107. For those of you just joining us, going into the opening bell about 27 minutes from now, equities near session highs, positive 0.5%. Let's get a Mike McKee view on things. Mike, you've had a third, fourth, fifth look at this. What stands out for you?
Well, I pretty much agree with what Rick says. It looks like a general slowing, but it isn't a terrible report. You look at the number, 150,000 jobs created, and you have to remember that 48,000 of them were not counted because of strike activity. 33,000 of those in the auto workers. We'll talk about that in just a second. But you get 180,000 jobs in that case, which is what the estimate was. Net revisions for the last 2 months down 101,000. Doesn't really surprise people because the number was so big last month. Unemployment rate does tick up by a little bit. And here's an interesting thing, the SOM rule. You've got to go up 0.5% based on a 3-month rolling average. We're up 0.4 now. Are we getting to the point where you might see recession? Yeah, hard to say in this case. Average hourly earnings certainly cooperating down to a 4.1% annual rate, which is what the Fed wants to see. Now, let's talk about this strike activity. 48,100 people were found off the job during the month of October, and 33,000 of those were auto workers. So what you get when you look at this overall is 180,000 or 198,000 if you put all the strikers back in, and that would have been an interesting question for the markets. And maybe you can ask Rick and Mohammed, what would the markets have done if we'd gotten 180 or 198,000 for a headline? Auto manufacturing, as I mentioned, lost 33,000 jobs. Manufacturing in total lost 35,000, but take away the auto workers, and it's only a loss of 2,000 jobs. And in 3 of the last 4 months, manufacturing's lost 2,000 jobs. Construction, though, is up. Private sector jobs, only 99,000. That might be something to keep an eye on as we're looking for slowing. And then, of course, something people will debate is we lost 201,000 people from the labor force and 348,000 in terms of household employment. That's very different than the 150 that the establishment survey found, so people may be debating that. But is this a bad report? Doesn't really look like it. It's bad compared to last month, but overall, it just shows the economy slowing a little bit.
Mike McKee, thank you, sir. Mike McKee teed us up. Mohammed, let's go there. If we added back in the auto workers, would this conversation this morning be different at all?
I don't think so, John. It would have been exactly the same because look at it over time. In fact, the expectation, the consensus number of 180 had that already adjusted. So I don't think we would be having a different conversation. I also don't think we'd be having a different conversation about policies. No, we would be having a different conversation about what's going to drive the bond market.
Rick, do you agree?
So I think so. I mean, but I generally agree. Listen, I think the Fed's done. I mean, I think that's it. I mean, we needed to see the pay. Everything else is moderating. And by the way, you look at the manufacturing data, including the earnings reports we got almost across the board. And then obviously you look at it to the extent that, which the Fed should look at the global conditions, Europe is really slowing. So I think you should assume at this point the Fed is done. By the way, month on month, we were looking at average hourly earnings and aggregate hours. And so you had flat income growth. I mean, that's, for the Fed, I think that's a big deal that it corroborates. Inflation is coming down, not straight line. Payroll is starting. Labor now is finally starting to come off a bit. So I think it's a big deal. And I think at this point that the Fed is going to be on hold for a while, and it probably could take December out of your calculation.
Mohammed, you heard it. The Fed's done. Rick Reeder, Andrew Honhorst, Citi. Also, the Fed is done. Mohammed, what do you say?
I agree with that. Not only do I think the Fed is done, I think the Fed should be done. And I think those numbers are just confirmation as to why the Fed should be done.
When you hear lines like this one, second paragraph, Mohammed, in the Fed statement, tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring and inflation. And then you look at the move we've had this week, 40 basis points lower on a 10-year. Mohammed, do you think we're unwinding some of what the Fed stated just a couple of days ago to the extent that maybe they have to take some of it back?
Yeah, I mean, they're getting into these vicious cycles. And they've got to be careful. I often think the Fed doesn't understand enough how their words are heard and read. But John, there is a bigger point. And you've heard me. I've said consistently on your show, starting over a year ago, there is no reason for the U.S. to fall into recession in 2023. I do worry, however, about 2024. I do worry about the cumulative effects of all these rate increases. As Rick rightly said, you see weakness happening all over the place. And we hope it's a soft landing, but keep an eye on it. Certainly the global environment is not going to help us. The global environment will be a headwind to the economy. So I worry that not only are we slowing and the Fed is done, I worry that the cumulative effects of everything that has happened may push us down too far.
I'm with you, Mohammed. It matters why the Fed's done. So, Rick, let's go there. You said the Fed is done. Let's throw in the data. we're seeing a slowdown in the economy. It's not a big call to make. We've just had close to 5% GDP growth in the third quarter. You're going to see that slow down, no doubt. Rick, is that sufficient reason to sit here and say, I want to buy risk, I want to buy stocks, I want to buy credit?
So listen, I mean, this is a pretty unique point in time that the yield, we've dropped, like you said, Treasury rates have dropped significantly. We've had some spread tightening. I still think these yield levels, particularly the front to the belly of the yield curve, you can clip. I mean, buying a quality fixed income portfolio, you can still clip. We put together portfolios that are 6.5, 7. We have some that we feel really good about that are 7.5 yield without really dipping down the credit spectrum. That is pretty, that to me, if you go into 2024 and think about, gosh, I can build a lot of income, I don't have to do it by going down into low quality sovereign or corporate. That's pretty attractive. And then, listen, I think equities will do their job. I mean, if you don't go into significantly deep recession, which I really don't think is going to happen, I still think there's almost $7 trillion sitting in money market funds. As long as you believe we're not going to get bludgeoned, capital won't get bludgeoned by the central bank continuing to raise rates. Yeah, I think it's a pretty good environment, both for equities and fixed income. Listen, our equities going to have this sort of incredible performance they had, particularly the big tech 7, Magnificent 7. No, I don't think so. But I think you can still have pretty good return in some of these risk assets and the yielding assets. If the Fed's not going to raise rates, your carry that you have in some of these income-producing assets in high quality are pretty darn attractive. And you saw, by the way, the last few days you've seen some pretty good buying of those.
Rick Mohammed, stick with us just to go through some of the levels. 2 Mondays ago, in the bond market on a 10-year yield, we had 5.0187% on a 10-year. We're down more than 40 basis points from those levels. This week alone, we're down 30 basis points on a 10-year Treasury to about 453 currently. Let's get you some movers going into the opening bell. Equities like what they hear this week, that's for sure. Good morning, Abby.
Good morning, John, and welcome back. We're looking at the best week since November of last year, and this bad news is good news jobs report. Well, it's certainly helping as yields plunge more. Some of the big tech names are higher once again. NVIDIA up 1%, in fact, heading to its best week since June of this year. We also have Tesla up 1.4%. Ruining the party just a little bit, Apple down 2.3% on that China miss. They posted about $15.1 billion worth of iPhone revenue in China versus the estimate of $17 billion, so about 11% miss. And it looks like the December quarter is a little bit light, but not plunging so much. It seems as though this risk-on mood is even helping out Apple from a deeper plunge. Risk-on mood today, John.
Abby, thank you. More on Apple around the opening bell. Coming up on this program, can we call it a Goldilocks payrolls report?
Labor market's still tight, right? So even, and I don't really think you need to look much beyond the unemployment rate of 3.8% to say, the nation's at full employment and markets are tight.
Coming up shortly, what the latest jobs figures could mean for the White House. That's next and later. iCapital's Anastasia Amoroso, PGIM's Mike Collins join us around the opening bell.
We should definitely see the impact of the UAW strike tomorrow in tomorrow's data. The BLS released their strike report. Between the strikes, the big three, and Mack Trucks, that should be about a 30,000 job reduction in motor vehicle and parts assemblies employment. That'll rebound in the subsequent report. And I think the bigger picture is that you have put in place for some of these contracts, a return to things like, cost of living adjustments, et cetera. So this should generally mean for these workers somewhat firmer wage gains over the next few years than would have otherwise been the case.
The US labour market is starting to cool. Impacts from the UAW strike, payback from the summer pop in hospitality jobs, and slowing labour demand peeking through. And workers across sectors are more concerned than ever about layoffs. Discussions about job cuts reaching the highest level since July 2020, and global industry bellwethers like Maersk cutting 10,000 jobs to shield profitability as it expects a weaker shipping market through 2026. AMH joins us now from DC for more. Morning, Anne-Marie.
Good morning, John. While the White House is parsing through this data and preparing what the president is going to say, likely he will talk about those UAW workers, roughly 33,000 individuals that work in the car and auto plants sector and that manufacturing were not part of this October release because they were out on strike. If they were, we would actually be more in line with the estimates for this report. So the president and the White House may want to talk about those nuances. Also a moment for him for once again to come out on the side of labor and talk about that historic deal. But overall, Jonathan, you're going to see this president talk about for the fact that this is 21 months in a row that the unemployment rate is under 4%. It's a statistic that this White House loves to promote. But the concern is, of course, as we go towards the end of this year and potentially into next year, it's one that may be waning. And then finally, I would say, given the past few weeks, we keep hearing from Secretary Janet Yellen talking about more evidence of a soft landing. Inflation is the biggest problem for this White House. They're probably going to want to say this is more evidence that inflation is coming down due to the Fed's aggressive rate hikes.
AMH, thank you. The update down in Washington, D.C. A week is a long time in this market at the moment, never mind 12 months until the next election, November next year. Mohammed, we talked about this bond market losing its anchors. The ECB, the BOJ, developments in China, the Federal Reserve. All it's taken is a 30 basis point move this week on a 10-year Treasury. And you get the feeling that people are starting to sense that maybe the old world is just around the corner. Have we fully internalized, Mohammed, this new regime?
John, we have to understand that we are in transition. For 2 years now, the bond market, in my opinion, has been influenced mainly by central bank policy. Whether it's 2022, the Fed and others having to catch up on inflation and hiking rates very aggressively, or this year when markets had to recognize that rates were going to stay higher for longer. I think the Fed actually and other central banks are going to be less of an influence. And when we look to next year, we're going to be talking about who's buying U.S. Treasuries. We're going to be spending a lot of time looking at auctions. It's going to be a different narrative. I must tell you, this is a really hard market also to figure out the technicals. For example, and Rick is better placed, if you're an investor in high yield, in 48 hours, you've seen 60 to 70 basis points of carry disappear from whatever you were going to buy. Forget about a week. In 48 hours, John, we have seen a massive spread compression, and we've seen, in addition, what's happening to Treasury. So when the yields move this much, it's not clear to me whether you attract more buyers or whether people stay on the sideline just wanting this volatility to go down. And there's no one better than Rick to give us a sense for how the technicals are going to play out.
Rick, the floor is yours.
So can I just go ahead with what Mohammed said? Next week, we're going to get Treasury supply of $500 billion. Next week, we're going to get, I mean, just reiterate, that's, by the way, that's 40 gross supply. That's 40% higher. This week is 40% higher than this week last year. The number's staggering. The amount of bills we're going to get Treasury refunding next week. Let's take the other side of it, the technicals. In the high yield market, the high yield market's $1.5 trillion market, but we're getting $500 billion of Treasuries next week. The whole high yield market's $1.5 trillion, and the issuance level is light, to say the least. I've never seen a more technically driven market. By the way, the equity market, part of why the technicals there are so well supported. This year, I think it's $800 billion of authorized buyback. There's $19 billion of IPOs. So you have buying, no selling, and the Treasury's issuing immense amounts of debt. So, I mean, in my career, I don't recall a more technically driven market than we're seeing today. And it's part of why some of these markets, single names, are so shallow. The depth of these markets is atrocious. It's because it's an incredibly technical market in almost all forms today.
Rick, when you say the depth of this market is atrocious, are you also talking about the Treasury market? And how much of a change is that?
So, the depth of the Treasury market generally is pretty good. It moves around with, and I think Mohammed said it, the auctions that we're going to get, there's going to be continued focus on can we keep pumping this much debt into the system on the risk-free rate, and that will be how you interpolate every other asset classes. That's a tremendous amount. The depth generally of the Treasury market's pretty good. It's not as good as it normally is because people are uncertain about whether it's geopolitics, whether it's these big rate moves. The depth of single name equities, the depth of some of the risk markets generally are pretty thin, and a lot of that is geopolitical risk that people don't want to get in the way of it, and a lot of it is just people sitting on their hands for a while. By the way, heretofore, sitting in money market funds and clipping 5+% or bills and getting 5.60 has been an attractive way to play it. So that's part of why you've got shallow depth in a lot of other markets.
Rick, do you need to see stability in Treasuries before you see stability elsewhere?
Yeah, I mean, so Listen, I think the first thing is the Fed, the concept of now that the Fed has data that is consistent, inflation, employment, that shows its moderation, that's a big deal. So you don't have the central bank that is twisting around in terms of the thought process. So I think that's a big deal. And then the other is, like you say, is can we keep digesting this much supply of treasuries? Listen, as long as the backdrop is pretty good around the data and the Fed, I think you'll start to see people push out of money market funds. We saw it, like Mohammed said, you saw it in the last 3 or 4 days, and my sense is that will be durable. It's like I say, it's a question. Listen, at some point, we're going to have to deal with how much treasury, how much government debt there is, and that to me is still a big governor on the risk markets for a while.
Mohammed, just a final word. I sense from you, you're not anticipating that stability anytime soon going into 2024.
I'm hoping for it, John. I'm really hoping for it. We've got to recognize that U.S. Treasuries are the benchmark not only internally, but internationally. And this crazy volatility, I mean, seriously, crazy volatility, means you complicate financial intermediation, you lower the standing of the U.S. globally, and you risk breaking something. So I'm really hoping for greater stability. Now it's not going to be just the Fed, and Fed communication has got to improve. It really has got to improve. There's been now several studies showing that part of the volatility we've had is associated with the way things are said by Fed officials. Let's hope that we do get it, because it's central to so many things, as Rick rightly says.
Well, they're getting plenty of practice, Mohammed. A lot of opportunities to talk again. Mohammed, thank you. Mohammed Al-Arian, Rick Reader, two of the very best every Payrolls Friday. Always enjoy your contributions, gents. Thank you. Coming up in the morning calls and later, from Payrolls to Apple. The conversation continues with iCapital's Anastasia Amoroso, PGIM's Mike Collins, Tom Fortier, D.A. Davidson, with a price target cut on Apple shares overnight. We'll catch up with him in the next 30 minutes or so. Live from New York City, big bond market rally. Yields lower by 14 basis points on a 10-year, 2-year down 13. Equity market with a pop. Futures up 0.5%. Your opening bout just around the corner. Small downside surprise on payrolls apparently is what this market wanted to see. Equities higher on the S&P by about 0.5%, and a big bond market rally taking place in the last hour as well. Treasuries look like this. Yields lower by more than 10 basis points, almost across the curve. 2s out to 30s. That's the price action. Let's get you some morning calls. First up, Wedbush downgrading Co-America to neutral, recommending defensive positioning ahead of a potential recession next year. Your second call from KeyBank upgrading Uber to overweight, expecting upside results after implementing new cost control measures. And finally, JP Morgan cutting its Apple price target down to $225 following earnings, seeing continuing headwinds due to a challenging macro environment. Coming up, more on Apple's disappointing holiday outlook with D.A. Davidson's Tom Fortier, plus more on the payrolls report with iCapital's Anastasia Amoroso and PGIM's Mike Collins. Your opening bell up next. Rick Reader, BlackRock, the Fed is done. This program, the last 30 minutes. Mohammed Al-Arian basically echoing that sentiment. Andrew Hollenhorst, Citi, the Fed is done. Morgan Stanley, Ellen Zettner, the Fed is done. You get the picture. That data breathes some more life into that conversation. Equities higher, going into the opening bell by 0.5%. Into the opening bell, and there it is, by the way. Switch up the board and get to the bond market. This week, equities higher Monday through Thursday. We could add some weight to the rally. We are poised for the biggest weekly pop of the year so far on the S&P 500. In the bond market, yields up, then yields down aggressively over the last couple of weeks. We're down 14 basis points this morning to 451. Just think about it. 2 weeks ago, 2 Mondays ago, 50 basis points higher. This week alone, we're down more than 30. That's the bond market move. Yields down, dollar weaker, foreign exchange, euro stronger, euro dollar 107.09. That currency pair positive by 0.8%, and crude backing away and backing away. October was awful for crude. A monthly move lower on WTI, even with the geopolitical tension. 81.43 on WTI right now. We're down by 1.2%. About 40 seconds into the session, equities look like this on the S&P 500, positive by 0.5%. The one stock to watch at the open, Apple, delivering a disappointing holiday forecast and weaker than expected revenue out of China. The CEO, Tim Cook, remains positive, saying this: the iPhone actually set a September quarter record in mainland China. It's an incredibly important market. I'm very optimistic about it. Anurag Rana at Bloomberg Intelligence joins us now for more. Anurag, can you go through the reasons to be optimistic right now on this company?
Yeah, I mean, you're always optimistic on Apple in the long run. This is a brand that does not lose its shine. It has a refresh rate or I would say customer satisfaction rate in the mid-90s. So people just don't get rid of their iPhone and get an Android device, at least 95% of them. But the real problem is that people are keeping their phone for a little bit longer than usual, and that's having an impact on near-term sales. No growth at all, but revenue growth for services, Anurag. Does that change how I value this company? It does change, but the question at hand is, can that go on for a very long period of time? Double-digit growth in services really stood out, and it helped margins. But the question is, can you grow at that same pace? The real importance is whether China is going to remain a big market for them or not in terms of growth or kind of a double-digit growth. And I think we'll take another quarter or two to figure out if they are losing some momentum over there. Anurag, great to catch up. Anurag Rana on Apple. That stock is down 1.6%. This market rallying hard. Monday, Tuesday, Wednesday, Thursday, again this Friday. Let's stick with tech. Block raising its annual forecast and launching a $1 billion buyback program. Ed Ludlow has more.
Good morning, Jonathan. The stock up 14%, on track for its biggest jump in a year. This is basically about users and consumers still transacting on the variety of Block, the company formerly known as Square's offerings. It boosted its forecast for adjusted profit in such a way that it's really moved the needle for the street. Adjusted EBIT for the year 2023, 1.66 billion to 1.68 billion, way up from the previously guided range of 1.5 billion. Also, it's difficult to put too much emphasis on active users as a metric, but MAUs going up significantly in the quarter.
Thanks for that. Let's turn to the travel space. Expedia announcing its own $5 billion buyback plan after topping earnings estimates. With more, I'm pleased that we can cross over now to Abby. Hey, Abby.
Hey, John. Well, investors are really liking this quarter a lot. The stock absolutely surging right now, up about 17%. Its best day since November of 2020. On the week, up 20%. The best week right now as of April of 2020. And it has everything to do with that $5 billion buyback that you just mentioned. In addition to the strong results, they beat both earnings and revenue. They put up adjusted earnings of $5.41, so not a small number. That was a 33% beat. They also put up revenue in a very solid way that beat by about 1%. Hotels, that beat. Interestingly, airlines, a little bit of a miss. But again, investors really liking this, and analysts as well on board with this very strong quarter and the buyback for Expedia. John.
The stock is up 16%. Abby, thanks for that. Let's turn to gambling. We can get to DraftKings. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yes, strong showing from DraftKings. Strong user engagement. Losses narrowed. Guidance was boosted as well. Let's go through that in order. Monthly unique players increased on the platform to 2.3 million in the quarter. That is a 40% jump from the prior year. And you also saw revenue per player increase as well. Now, DraftKings, it did post a third quarter loss of about 62 cents a share, but analysts had been expecting a loss of 69 cents a share. And just for context, DraftKings saw a loss of $1 per share in the same period last year. So obviously a big improvement there. And lastly, DraftKings also raised its fiscal year revenue guidance as well. And the sell side is psyched, to say the least. You take a look at this note from Truist, which already had a buy rating on DraftKings. The analysts had expected the results to be a, quote, standout, but analyst Barry Jonas said after the report that these results already surpassed his high expectations. Added together, you can see DraftKings absolutely flying this morning, up about 7.5%, John.
Katie, thank you. This market's been flying. Let's get to iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, what a week.
It's been a week for sure, John.
This move in the bond market, you seen a recipe for further bond market stability after that payrolls report?
I mean, I do. And I think it's not just about the payrolls report, but several factors that have been propping up the bond yields here. You know, first of all, the payrolls report was picture perfect, I would say, for the Fed, for the equities market, and for the bond market. The reason I say that is because we got an uptick in unemployment rate. We got the slowdown in the pace of job creation. So that really tells you that the economy is likely to slow from sort of the breakneck speed that we saw in the third quarter. So that's easing some pressure from the bond market. But then I think there are two other developments this week that are really important. And one, of course, is from the Fed. They really are taking note in the long end of the curve and saying that is likely tightening financial conditions. But then you couple that with the announcements that we got from the Treasury this week, which is on the borrowing that they're going to do and exactly what they're going to issue. And I think that was a really good piece of news for the market because they're not what they're going to borrow sort of met estimates or maybe even undershot it. And they're going to borrow mostly in the front end of the curve. So that's easing the pressure on the long end of the curve. So you put all of those things together, and I think we do have a recipe for a pause, if not a further fall in yields. And of course, John, as we talked about, you want to buy those spikes in yields. You want to buy the tech on those spikes, and hopefully investors have been doing that throughout October.
Mike, are you feeling a little bit more comfortable now in fixed income?
Yeah, Jonathan, I think the bond market, interest rates in the bond market are now actually just coming back down to earth. When they were hitting 5% and the Fed funds rate that was priced in permanently was pushing at 4.5%, I certainly thought interest rates across the curve were probably 50 to 100 basis points too high, that they overshot. And we saw that really with the inflection a month ago in the big jobs number we had. Of course, now with this volatility in the market, we've seen a full, as you pointed out, 50 basis point retrenchment, not only in the 10-year, but in the Fed funds rate expectations now are for a funds rate kind of in the 360s by the end of 2025 and 2026, which seems a lot more reasonable to us. So maybe now bonds feel more fair value.
So, Mike, what have you been buying this week?
Yeah, so, we actually took advantage, Jonathan, on the credit side. As you know, we were short duration probably most of the early part of the year. We covered that in and have been kind of neutral here with this big backup. On the credit side, though, as Mohammed pointed out, you actually had a big backup in credit spreads. I mean, high yield spreads widened over 100 basis points from where they were, a year and a half or so ago, and getting into the mid 400s was a pretty attractive entry point for us. So we've been buying a little bit of front end high yield and other high quality credit on the margin with the backup we've seen. But of course now that value proposition has kind of been wiped out pretty quickly as well. So really, like always in the markets, Jonathan, what to do now is always the hardest question.
Yeah, this is stuff we should have probably done yesterday. Anastasia, let's build on some of that and breathe some life into the equity side of the conversation. The banks this week, fantastic. This week, good. This year, terrible. Is there something to like now?
I mean, I don't like the banking sector, John. And, of course, like everything else, the banks can also rally into year end if we have this pause in yields and still constructive sentiment. But my concern about the banking sector is that I do think 2024 is going to be a harder year from the perspective of the economy, and especially from the perspective of charge-offs, delinquencies, bankruptcies, and defaults. And if you think about what one sector is most likely to feel all of that, whether it's defaults in commercial real estate, whether it's bankruptcy filings, whether it's consumers defaulting on perhaps their credit cards, I think it goes all right back to the banking sector. So for that reason, I'm a little bit more cautious on the banks. And then, John, the other issue, with the banks, there was a period of time where I did have some optimism for the sector, and that was predicated on the return of capital market activity. But we haven't seen really that return materialize in the third and fourth quarter so far of this year. So I think it's really too early to say that that's going to prop up the earnings of those banks. So I'm sticking with technology. And if you look, John, for example, at the NASDAQ, the S&P did pierce below 200-day moving average. The NASDAQ 100 never did, and it bounced right off of that level.
So from your perspective, the best way to play bond market stability, I should rephrase bond market stability as a bond market rally, is not through, say, the financials. You think it's still through tech?
Yeah, I absolutely think so. I mean, tech has gotten, I would actually characterize it as unfairly punished by higher bond yields. And when I'm talking about tech, I'm specifically talking about the profitable technology. And the theory goes that higher bond yields impact negatively tech valuations. And maybe that's true. But if you think about it from the fundamental perspective, tech is really not that much impacted by higher yields because tech is one of the sectors that has the lowest leverage in the S&P. And if you think of tech, they also don't have a whole lot of oil leverage either. So I actually think it's one of the more immune sectors from these macro headwinds. And again, if I look at tech today, it's trading, lower in terms of multiples than it was during the summer. It's bouncing off the technical level. So I think that's the best way to play the retracements we're seeing in yields.
It's an easier story to tell with yields 50 basis points lower than where they were 2 Mondays ago on a 10-year. Mike, can we just talk about where we've been and where you think we're going? I mentioned this to Rick and Mohammed. When you get a rally like the one we've had this week, there's always this temptation to extrapolate that out and start to think about the world we were used to only a few years ago. Mike, what is it about this regime that you think might stick for the next several years?
Yeah, our biggest worry, Jonathan, and Randy Krasner on your show pointed this out earlier, that the Fed is going to be very reluctant to cut rates here, right? So now there's 100 basis points of cuts priced in next year and about 75 in the following year. Maybe that happens, right? And I think you would really need a steady kind of slowdown for that to happen. But I think the Fed is going to be late to the game. They are going to err on the side of keeping the funds rate higher than they should for longer than they should, probably at least for the next phase of this cycle. So if you do have a slowdown, the risk is that you don't have the monetary, stimulus, and you certainly probably won't have a lot of fiscal stimulus given the dysfunction in Washington to provide that support that we've all become used to. So you could have a period of a couple of years of just kind of below trend, sluggish, maybe even a mild recession type of environment where you don't have that government, impetus to support. So that's really one of our concerns. Our fundamental analysts are looking from the bottom up and starting to see a lot of those cracks emerge, right? And if these short rates stay higher for longer, and obviously you've had a big relief on the rest of the curve in the last few days, but it does put pressure on companies and consumers and all kinds of businesses and commercial real estate as time goes on. So that's really what we're focused on.
Mike, Rick mentioned the supply dynamic into next week. Just going through treasuries, 3-year, $48 billion next week. Next week also $40 billion of 10-year notes, $24 billion of 30-year bonds. We're rallying hard into that, Mike. Is that going to go okay?
I think it'll go fine. This is probably the question we get most from our clients, at least in the last few months, Jonathan, is supply. What is going on, right, with the U.S. government supply? And actually, if you look at our debt to GDP, it has come down steadily since the peak in COVID because the denominator, nominal GDP, is up 38%, Jonathan, in this country in 3 years since the bottom in COVID. That's the biggest gain in nominal GDP we've seen since right after World War II. So I think our debt situation is probably more sustainable than people are worried about. Supply dynamics historically do not have any empirical relationship really to the level of interest rates. It's been a global bond sell-off. And if you look at the world and the bond market opportunities, I think the U.S. market is still really attractive to foreign investors and even to U.S. investors.
Mike Collins, Anastasia Amoroso, to the two of you, thanks for being with us. A constructive view there on both fixed income and parts of equities. About 14 minutes into the session. If you are just joining us, where have you been? 150,000, downside surprise on payrolls, the estimate 180. That's the number for the headline number on payrolls. The reaction, equities up and up big, up 0.8% on the S&P on the session. On the week, up more than 5%. We're down hard on yields on a 10-year, down 17 basis points on the day, down more than 30 basis points over the previous 5 sessions. On a 10-year right now, we've broke 450 at 449. Coming up, Apple delivering a disappointing outlook for the holidays.
I do think there is one reality, and that is that I think Apple has come to grips with the fact that it needs to have a more diversified kind of Asia strategy.
More on Apple's latest results with D.A. Davidson's Tom Forte. That conversation up next.
it's no secret that consumer and government sentiment hasn't been all that positive around Apple for the last, I'd say, couple of months in and around the greater China region. And yes, I mean, we have heard rumblings that competition is greater perhaps now than it was over the course of the prior year. I do think there is one reality, and that is that I think Apple has come to grips with the fact that it needs to have a more diversified kind of Asia strategy.
Apple delivering a disappointing holiday outlook, a fourth consecutive quarter of slowing sales with weakening revenue out of China. The CEO, Tim Cook, saying this: we continue to face an uneven macroeconomic environment, including foreign exchange headwinds. D.A. Davidson cutting its price target down to 166 after the results, writing the following: China risk is high. The weak macroeconomic conditions are negatively affecting sales. There's escalating tensions between governments, and the company is still overly dependent on China's supply chain. I'm pleased to say that Tom Forday joins us right now. Tom, great to catch up with you, buddy. One thing you didn't mention there, I don't think, was competition within China domestically. Tom, is that showing up at all?
It is showing up, but the way that I think about the China pressure is primarily the challenging macroeconomic environment. You had a very muted reopening trade after the end of COVID zero. And then secondarily, the escalating tensions between the two governments, with Apple kind of caught in the middle.
You know, the revenue mix is shifting. Services growth is better, Tom. Margins are still healthy, better than good. Is that enough to hold up this stock from your perspective, in your opinion?
Services is good, but they need to have more hardware ultimately to get more services. My concern is this puts more pressure on the Vision Pro, which is expected to come in the beginning of calendar next year, but with a $34.99 price point, or $3,499, and likely not getting the subsidies from the wireless carriers like the iPhone. I think the next 12 months are going to be challenging for the stock.
Tom, that's the big question. China down, Europe down, Japan down. You mentioned the hardware challenges. Are they losing pricing power?
I don't think they're losing pricing power. So if you look at the iPhone results, they essentially benefited in the 15 from a de facto price increase. They're not offering the lower memory option, which means if you want the Pro Max, you got to pay $100 more. I think they have pricing power. They're trying to increase prices on the services. But again, the challenge is if they don't get more hardware in the consumer's hands, can they continue to grow services? And given the relative higher margin, can they maintain their multiple? And I think that's in doubt.
Tom, you've cut your price target. I understand that. If you told me all of these things at the start of the year, there is no way I would have guessed the stock would be up year to date by more than 30%. Which begs the question, Tom, what is driving the stock? And why would that change?
What drove the stock was a flight to quality in a very challenging period for the stock market. You had, bank closures, things of that nature. And then excessive enthusiasm about, either the China reopening or the company's ability to continue to pump the iPhone and generate shares higher. I think that's what drove the stock performance. It's a great company, generates a ton of free cash flow, but the challenges are very significant. As you pointed out, 4 consecutive quarters of declining revenue to be followed by a flat quarter. It's tough.
What kind of multiple, Tom, does this company deserve now?
I think that the current state of the business, it's hard to suggest you get more than a mid-teens multiple, with the mid-teens driven by the quality of the company, the very significant free cash flow it generates, and the potential that after they slog through kind of a couple more challenging quarters, growth returns and resumes. They still have to manage the overdependence on the iPhone, which is another challenge for the stock and the multiple.
Tom, appreciate the update. As always, Tom Forday there with D.A. Davidson on the latest. Thank you, buddy. As always, the stock is down 1%. The market's up 1% on both the S&P and on the NASDAQ as well. Let's get you some sector price action. Here's Abby.
Not surprisingly, John, very bullish sector action. 10 of the 11 S&P 500 sectors are higher. And very interesting, it's not the usual sectors that are on top. We have real estate, consumer discretionary, materials, and utilities. Real estate, the best one, up 3%, having to do with yields plunging. Those dividends look more attractive. On the week, we have a similar situation, just energy down. The top sectors on the week, there you have real estate. The best week, John, going all the way back to 2021. And as you mentioned, the S&P 500 on this broad sector strength, well, the best week of the year.
Big day of gains, big week of gains. Abby, thank you. Coming up next, your trading diary, a sneak peek of next week. This market is absolutely flying. Stocks up across the board. That's the price action. Let's get to the trading diary. Coming up, what you need to be watching this week, the ISM services coming at the top of the hour. Then next week, you get a ton of bond issuance, 3-year, 10-year, 30-year, along with earnings from Uber and Robinhood and eBay as well. Wednesday, Disney after the close. And on Thursday, you'll hear from a load of Fed speakers, including Chairman Powell. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Enjoy your weekend. This was the countdown to the open. This is Bloomberg.